Hello and welcome to this webcast on benchmark reform and the opportunity to learn about the impact on derivatives and hedge accounting under IFRS. My name is Antonio Corbi. I am a director at ISDA and I am responsible for our global accounting initiatives. I'm joined by a group of 4 hedge accounting experts dealing with accounting transition to risk-free rates. I will introduce them briefly by order of appearance. First, Tony Clifford, who is a senior advisor at EY's Financial Services in the UK. Then Steve Wolf, who is head of banking volatility management at Lloyds Bank Group. Then David Bradbury, who is a director at EY's Financial Services. And finally, Fiona Thompson, who is Managing Director and International Head of Accounting Policy at Goldman Sachs International and Chair of ISDA's European Accounting Working Group. They will walk us through the impact of the IASB's proposal to amend IFRS standards. Before that, I will start with a short intro with a bit of background including key derivatives transition milestones in 2020. Most people will be familiar with the risk-free rates working groups. These groups were created in response to the 2014 Financial Stability Board's report setting out recommendations to reform benchmarks. The 5 working groups that you see in slide 2 are those where ISDA has got representation, but there are, in fact, many more working groups set up from Canada to South Africa, and all have identified alternative risk-free rates. These rates are not uniform. They have different histories. Some are based on secured transactions and others on unsecured. Some have been used for a long time in the financial markets, and others are just created to replace benchmarks that are due to cease. There are many websites with information on transition, but I will recommend looking at ISDA's website because there is a new hub that pulls together a lot of information from different sources, and for those interested in benchmark liquidity and trading, ISDA publishes a quarterly review. Slide 3 shows the work that ISDA is undertaking to amend the 2006 definitions for derivatives contracts that will incorporate fallbacks for 11 key IBORs. The FCA in the UK has stated clearly that banks will not be able to compel or to submit LIBOR quotes beyond the end of 2021. Therefore, the future of LIBOR in these 5 currencies is uncertain and must be replaced. There are fundamental differences between IBORs and risk-free rates. For example, risk-free rates are overnight rates and nearly risk-free, while IBORs incorporate multiple tenors and bank liquidity and credit spreads. Therefore, some adjustments are necessary to ensure that derivatives contracts continue working as closely as possible to the original agreement in the time of transition. The fallbacks will apply upon permanent discontinuation of each IBOR based on predetermined triggers. You can find a lot more information in our website. Slide 4 examines the major developments related to the adoption of risk-free rates during 2020, of which I would highlight 3 things. First, the publication by Bloomberg of IBOR's fallback rates in April and monthly data test since May this year. Second, the change of discounting and PAI alignment for STR and SOFR announced for July and October 2020. And third, the publication of the IBOR fallback supplement and the protocol by ISDA expected at the end of July 2020, which will be effective 4 months later. Slide 5 shows the timeline of the accounting project. The ISB posted the first agenda papers late in 2018, and ISDA members have been eager to contribute to the project since that time. The board identified two groups of accounting issues and divided the project into two phases. Phase 1 applies to derivatives before the transition kicks off. ISDA responded to the exposure draft in May 2019, and the amendment was published in September that year. The amendments are expected to be finalized this year in quarter 3 or quarter 4. And the EFRAG and the European Union need to work fast to endorse the amendment in time to be effective from the 1st January 2021. I will now hand over to Tony Clifford, who will clarify Phase 1 and Phase 2 of the ISB project. Tony, thank you for joining this webcast.
Antonio, thank you. So Phase 1, I'll give a brief overview of what it's all about. As Antonio has already mentioned, this phase was completed last year. The effective date was the beginning of this year, but early adoption was possible, and many banks did apply the amendments during the course of last year's annual accounts. Now, for Phase 1, the main issues are that the IBOR-based cash flows are no longer highly probable or even probable of occurring, both of which, of course, are key requirements for a successful cash flow hedge. Further, if you don't know whether IBOR is going to continue or for how long, it's not possible to measure or assess hedge effectiveness. And therefore, the relief in Phase 1 is straightforward. It is to assume that IBOR continues, so that you can continue to assume that it's highly probable and will occur, and therefore you can use your projections of IBOR occurring in order to assess and measure hedge effectiveness. Phase 1 also gave relief from the IAS 39 80 to 125% test. So if the hedging derivative is modified before the hedged item, so you have a mismatch between the two, the hedge won't fail, but on the other hand, this does not give relief from having to measure and record ineffectiveness that arises. Also, it's possible under IFRS to designate as the hedged item a separately identifiable component of a risk or cash flows. And as it may no longer be possible to separately identify IBOR as a component, the relief allows the test that the component is separately identifiable to be met only on initial designation, and the test does not need to therefore also be met throughout the hedge relationship. Now, Phase 1 continues until the hedge relationship is discontinued, or when uncertainty arising from IBOR reform is no longer present with respect to, on the one hand, the hedging instrument, or on the other hand, the hedged item. In this context, uncertainty refers to both the amount and the timing of benchmark-based cash flows. It's also worth noting that Phase 1 came with a number of disclosure requirements. If I turn to the next slide, this sets out the agenda for most of the rest of this webcast, as we'll talk through the major elements of Phase 2, as shown on this slide. So the ED was issued in April with a fairly short comment period, and the ISB redeliberated most of its contents in June and have one further meeting in July. And they seem to be on track to publishing the final standard, hopefully in Q3, if not possibly early in Q4. So if I move to the next slide, I'll start talking about modifications. I'm going to pull out three key elements of the ED's proposals. The first is to include in the scope of modifications for this exercise where the way that the benchmark is calculated changes, even if there's no change to the contractual terms of the financial instrument. So an example will be back last October, Eonia was redefined to be equal to ISDA plus 8.5 basis points. With this change in the specification of a modification, that would fall within the scope of this project. Because although the financial instrument may still refer to EONIA, the way that EONIA has been calculated has changed. However, that does not have a huge impact, as we'll see in a moment. Second, there's guidance that modifications of instruments from an IBOR to a risk-free rate on their own are unlikely ever to be a substantial modification, and therefore is unlikely to result in the derecognition of the financial instrument. However, you should watch out for any other amendments made at the same time. So if, for instance, a loan is renegotiated between the lender and the borrower in order to be able to reference a risk-free rate such as SOFR, but at the same time there's a change in the tenor of the loan or the credit spread or some other features, these will need to be looked at in the round to determine whether there has been in total a substantial modification, in which case we might need to derecognize the instrument and recognize a new one. But in the vast majority of cases, that won't arise. In the vast majority of cases, just changing the reference rate, even if other changes are made at the same time, is likely still not to be viewed as substantial. However, if we don't derecognize the original instrument, if it's recorded at amortized cost, there is some special accounting required under IFRS, and the paragraph number in IAS 39 is better known than the paragraph number under IFRS 9, and this is the famous AG8. You're required, if you modify a financial instrument at amortized cost or at fair value for other comprehensive income, to adjust the instrument for the net present value of any change in the expected cash flows discounted at the original effective interest rate, and there's an offset to profit or loss, but you keep the original effective interest rate unchanged. Clearly, that is not going to be practical if the benchmark on which the EIR was based is itself no longer relevant and might not even exist. So therefore, the key relief in this part of phase 2 is to allow entities to treat the movement from IBOR to an RFR as a change in a floating rate, which means you can change the effective interest rate and means that in itself there's no catch-up adjustment to profit or loss. However, there are two constraints, two conditions. The first is, this is only going to be true to the extent that the modification is required due to IBOR reform. So any other changes that are made to the instrument at the same time have to be dealt with through the normal rules and may result in a P&L catch-up adjustment. And secondly, this only applies if the replacement in the reference from IBOR to RFR occurs on a basis which is economically equivalent. By this, which is an undefined term, I would understand this to mean that broadly the instrument has the same fair value before and after, and probably also has roughly the same interest rate sensitivity. If I turn to the next slide, I'll talk briefly about the views that the ISDA members had on these proposals. And the key point is that in general, ISDA members were pleased with what has been proposed. However, a few points here on this slide. For the first of the items I'd mentioned on the previous slide, the increase in the scope of what is a modification, there is concern amongst members. First, because this increase is not actually needed in this project, since relief is given in any event. And secondly, because it establishes a principle which may have wider and possibly unforeseen implications. However, the IASB so far does not seem to be minded to amend this. It does form part of a wider exercise to clarify the accounting for modifications of financial instruments in general and assets in particular. And this does seem to be an important element of that program for the IASB. Second, for cash instruments, if the terms are not amended before IBOR ceases to exist, the fallback language in many contracts would probably not result in the substitution being economically equivalent, and therefore the relief set out in phase 2 will not be available. It's difficult to see what the IASB can do with this problem, and therefore I don't expect them necessarily to change the requirements in the final version of the standard. It means that entities will have to modify all of their cash instruments before the transition, before the fallbacks are activated, in order to avoid some accounting issues. But having said that, regulators do seem to be pushing for these fallbacks to all be changed in any event, in which case this issue may not actually arise. And the third issue is quite simple. The modification language that I've been talking about is currently proposed to be within the IFRS 9 hedge accounting rules, which would not work very well for any entity that's using IAS 39 hedge accounting, because it means they won't be able to access the modification changes. This issue is understood by the IASB, although the staff in the last papers said that they would consider moving the staff into the right part of the standard, and I assume they will. That's all I wanted to talk about at this stage. Back over to Stephen to talk us further through the hedge accounting.
Thank you, Tony. Slide 10 outlines some of the key points in the exposure draft around amending hedging relationships as a consequence of IBOR reform. When there is no longer uncertainty around IBOR reform, for example, when a financial instrument is transitioned to an alternative benchmark rate, then the ED permits certain updates to the hedging relationship. These updates cover changes to hedge documentation to reflect possibly a change in the hedged risk and/or changes to the hedging instrument and hedged item, and additionally, updates to the approach adopted for assessing hedge effectiveness as a consequence of a change due to IBOR reform. Slide 11 highlights some of the concerns that were raised in the comment letters on the exposure draft to the IASB. One of the key concerns raised was that it was felt that the exposure draft was focused on where financial contracts were modified as a consequence of IBOR reform. Respondents felt that the exposure draft didn't cover other approaches entities may adopt to transition their financial instruments, of which, with respect to the derivatives market, there are likely to be several potential routes to transition. As an example, existing IBOR reference derivatives may be terminated and replaced with new derivatives, referring to new alternative benchmark rates such as SONIA. The IASB staff covered this point in the agenda papers presented to the board for the June meeting. Here, they highlighted the other potential routes to transition that entities may employ for derivative contracts and recommended to the board that it is the substance of the arrangement rather than the form that should determine the accounting treatment. What does this mean? Well, the IASB staff concluded that if you terminate an existing IBOR derivative and replace this on an equally economic basis with an off-market alternative benchmark rate derivative with substantially the same terms as the original IBOR derivative, then this would potentially lead to the same outcome as modifying the contractual terms or repapering the derivative contract. Hence, the expectation would be for hedge accounting to continue in this case. However, in the case where a derivative is terminated and potentially cash settled and a new at-market alternative benchmark derivative is transacted, then the IASB staff proposed to the board that this would not fall within the scope of the ED as a continuation, as the replacement hasn't been made on an economically equivalent basis. Also, it's worth noting that some respondents also expressed the view that overlaying a new basis swap that swaps the IBOR reference cash flows on a derivative to an alternative benchmark rate can achieve exactly the same outcome as modifying the contractual terms of the original derivative to a new alternative benchmark rate. Here, the IASB staff agreed that in principle, overlaying a basis swap does achieve an outcome that is economically similar to modifying the original IBOR derivative. However, the staff felt that for this to work in practice, the basis swap would need to be coupled to the original derivative and hence transacted on a specific individual derivative basis, so that it is equivalent to the terms of each individual derivative being modified. However, in practice, the IASB staff felt that basis swaps are generally transacted on a portfolio basis rather than an individual derivative basis. With regards to bilateral derivatives that are not cleared via a central clearing party, respondents asked the IASB to clarify whether a novation of a derivative from one counterparty to another, and then the subsequent modification of that derivative to an alternative benchmark rate would lead to the derivative being considered in scope of the ED, and hence permit the continuation of hedge accounting. The IASB staff, in their agenda papers for the June board meeting, gave the view that assuming the novation is not to a central clearing party, then the novation would result in derecognition of the original derivative and hence would not be eligible for the continuation of hedge accounting. In the June board meeting, the IASB board accepted these views. Another concern raised in the comment letters was around ensuring the wording of the ED is clear that multiple changes can be made to a hedging relationship to reflect the potentially staggered approach to transition for the hedged items and hedging instruments that are in a hedging relationship. Again, in the June board meeting, it was accepted that some further wording clarifications will be made to the ED to make it clear that there is an expectation that multiple changes to a hedging relationship are permitted, where they are as a consequence of IBOR reform. Slide 12 outlines the key points from the exposure draft with respect to accounting for qualifying hedges. The first point is that when a financial instrument designated in a hedging relationship is transitioned from IBOR to an alternative benchmark rate, then the remeasurement of the hedged item and hedging instrument is based on the alternative benchmark rate, with any ineffectiveness being recorded in the P&L. The second point raised in the exposure draft proposes that when the hedged item designated in a cash flow hedge is updated to the alternative benchmark rate, then the future cash flows will be based on this new alternative benchmark rate. The third point covers groups of items, such as, for example, a portfolio of IBOR index loans designated in a cash flow hedge, and the ED recognises that the transition of these loans away from IBOR is likely to be staggered and not all transitioning at the same time. Here the ED is proposing to allow a group of loans designated in a hedging relationship to be split into subgroups where each subgroup reflects a particular benchmark rate. So as an example, in one hedging relationship, you could have a SONIA index subgroup and a LIBOR index subgroup. Any proportionality test used to demonstrate that the change in fair value of each individual item in a group is expected to be approximately proportional to the overall change in fair value of the group would be applied at each subgroup level. The final bullet point on slide 12 is around retrospective effectiveness testing, and here the ED proposes that when a hedging relationship is updated as a consequence of an IBOR reform-related change, then the cumulative fair values of the hedged item and the hedging instrument are reset to zero. Slide 13 outlines some of the key concerns raised in the comment letters around the ED's proposals for accounting for qualifying hedges. With regards to resetting the effectiveness testing to zero as and when the hedging relationship is updated, it was felt that this should be optional rather than mandatory, as in certain cases and under certain market conditions, starting the retrospective effectiveness testing again could lead to a hedge that has been highly effective historically being ineffective on restart. Hence, assuming the hedging relationship is permitted to continue when IBOR-related changes are made, it would seem sensible to allow entities the option to treat the effectiveness testing as a continuation as well, and hence include historical retrospective effectiveness testing results. Another point that was raised in the comment letters was around making it clear in the final wording of the ED that the hedge designation may be changed, even though uncertainty remains around the hedged item. As an example, this could be such as a case where you have a LIBOR loan as the hedged item in a cash flow hedge, and though the loan has yet to be transitioned to a new alternative benchmark rate, if the hedging instrument is transitioned from LIBOR to SONIA and the change falls within the scope of the ED as a continuing hedge, then you are likely to want to update the hedged risk to SONIA as well. And therefore, if you are using a hypothetical derivative to represent the loan, then you would want to amend the hypothetical derivative to reflect SONIA as well. A final point raised via the comment letters was around remeasurement. Here, respondents felt that the ED wording in certain paragraphs covering remeasurement, such as paragraph 6.9.7, needs to be clarified to ensure that all relevant changes that will come about as a consequence of IBOR reform are reflected for remeasurement purposes. The comment letters suggested that the examples in paragraph 6.9.4, covering things like the addition of a fixed spread to a new alternative benchmark rate to compensate for a basis difference between the old IBOR rate and the new rate, should also be included in paragraph 6.9.7. This will ensure that hedge designation amendments are not entirely restricted to updates of the new risk-free rate, and other required changes such as spreads are considered not permitted. The topic of accounting for qualifying hedges wasn't on the agenda for the June IASB board meeting, but has been scheduled for July, so we won't know for a few more weeks now whether the above feedback will be incorporated into the final ED. That's all I want to say on these two topics for now, and I will now hand over to David.
Thank you, Steve. This slide, number 14, considers the points with respect to the designation of risk components and portions. Under the proposals in the ED, for groups of items that are designated as hedged items, the IASB will provide reliefs, such that as they transition from IBORs to RFRs, they are allocated to subgroups based on the benchmark rate to which they refer. This was just mentioned by Steve. This approach can be applied to groups of items that identify risk components or portions as the hedged risk. The relief means that the hedging instruments will continue to form part of the same overall hedging relationship, referencing the original IBOR and then the new RFR, and therefore allows the original hedging relationship to continue. The IASB will discuss the feedback on these proposals in detail at their meeting in July before finalising the requirements in this area for the Phase 2 amendments. Under the IASB's proposals, an RFR may be designated as a non-contractually specified risk component or a designated portion if it is reliably measurable and is expected to be separately identifiable within 24 months. This is a new relief which ends at the earlier of either 1, 24 months after the initial designation of the RFR component, or 2, when the entity becomes reasonably certain that the risk component will not be separately identifiable within 24 months after the RFR is initially designated in a hedging relationship. In either of these cases, when the relief ends, the hedge or hedges would have to be prospectively discontinued. No relief is provided from the requirement for the risk component to be reliably measurable throughout the life of the hedging relationship, and any hedge ineffectiveness would be recognised in profit and loss as normal. The relief only applies for uncertainty arising directly from IBOR reform as to whether an RFR risk component is separately identifiable. The relief is not available for hedging relationships where there is uncertainty whether the risk component is separately identifiable, but the uncertainty is not as a direct result of IBOR reform. There has recently been some concern expressed by market participants, including some of ISDA's members, that some of the new RFRs may not meet the separately identifiable requirement within the 24-month time period of relief that the IASB is allowing. This has been expressed as a concern in particular for SOFR, as it is not clear whether this benchmark will ever meet the separately identifiable requirement for both derivatives and cash instruments. For example, it might be separately identifiable for derivatives, but not cash instruments, or even potentially vice versa. At its June meeting, the IASB discussed this concern and considered whether the period of relief should be longer or even open-ended. The IASB decided to keep the 24-month time limit to ensure that the relief has a clear end date. This is because the relief is intended to be a temporary measure, and in order to maintain the integrity of the hedging counting requirements in IFRS 9 and IAS 39, it needs to have a clear end date. The IASB also noted that entities will be able to control when the 24-month time period of the relief starts, as this will be when they first transition an instrument to an RFR. Therefore, the 24-month time period will be retained in the final amendments. With respect to the IASB's proposals for amending hedge relationships as hedging instruments transition from IBORs to RFRs, ISDA's members identified that where an RFR is specified as a hedged risk, it needs to be possible to add a fixed spread to compensate for this basis difference, which may be present between an IBOR and an RFR when instruments transition. The exposure draft was understood by some as potentially preventing a fixed spread from being added to a designated hedged portion of risk and only permitting the RFR risk to be the designated hedged portion. At the IASB's meeting in June, it was agreed that adding a fixed spread to an RFR to compensate for the basis difference would be permitted, and this would be clarified in the final requirements. On one of the later slides, we run through an example to illustrate this. The exposure draft included references to zero coupon bonds to support the separately identifiable requirement. In existing IFRS 9, it describes how the presence of a term structure of zero coupon real interest rates is required to demonstrate the risk component as being separately identifiable for the specific example of inflation-linked bonds. ISDA's members noted that in practice, a difference could arise in the development of term structures for derivative instruments and cash instruments. As mentioned a moment ago, it will not necessarily be the case that a term structure will develop for both cash and derivative instruments in the same RFR at the same time. The IASB also considered at their June meeting whether there could be other ways in which the separately identifiable requirement could be demonstrated to be met. One of the suggestions which ISDA put forward was that an additional indicator that an RFR is separately identifiable could be if the local regulatory authority has deemed an RFR to be an eligible replacement for an IBOR. The IASB, however, decided not to introduce any further indicators for whether an RFR is separately identifiable because they wish to retain the 24-month time period as this provides the end date for the relief and chose not to introduce any additional indicators. Differences presently exist between the description of the separately identifiable requirement in IS 39 and IFRS 9. Current practice is established and well understood, and ISDA's members suggested that this should not be reinterpreted by the amendments. The IASB confirmed that there is no intention for the Phase 2 amendments to change current established practice under IFRS for how the separately identifiable requirement is met in practice. This was discussed at their June meeting, and suggests that no specific additional guidance will be added to what is already present in IFRS. We will, though, have to wait and see how the final amendments are worded once they are published later this year. Moving on to the next slide, number 15, on effective date and transition. The amendments proposed that hedges should be reinstated if the hedging relationship was discontinued due to IBOR reform. ISDA's members identified that in some circumstances, this may give rise to problems. For example, hedges may have been terminated or compressed as part of the entity's ongoing activities, or they may have been designated in a new hedging relationship. In response to these concerns, the IASB agreed at its meeting in June that it will not be mandatory to reinstate hedging relationships if hedging instruments have been subsequently designated in new hedging relationships. In particular, the IASB clarified that to avoid these practical problems, which ISDA has identified, then where hedging instruments have been discontinued or designated, they shall only be reinstated if either, firstly, they were discontinued solely due to changes required by IBOR reform, and secondly, on initially applying the amendments, the discontinued hedging relationship still meets the risk management objective on the basis of which it initially qualified for hedge accounting and that it continues to meet all other qualifying hedge accounting criteria. So this substantially addresses the concerns raised with respect to the requirement to retrospectively reinstate the requirements. However, it should be noted that the transition requirements still present entities with a practical issue which they need to consider and plan for. This relates to any financial instruments that the entity transitions from IBORs to RFRs before the entity applies the Phase 2 amendments. The issue is that if those instruments which transition form part of a hedging relationship, and if the hedging relationship is discontinued as a result of the transition, the entity will need to maintain two sets of accounting records for these instruments. Firstly, as if the hedging instrument has been discontinued, which will be used before the Phase 2 amendments are applied. And secondly, as if the hedging relationship has been continued, so that it can be reinstated as if it were never discontinued once the Phase 2 amendments are applied. The effective date for the amendments is January 2021, with early application permitted. And entities will need to consider how to meet the disclosure requirements, which we discuss further on a later slide. I'll now hand over to Tony, who will take us through some examples which illustrate the application of the amendments.
Thank you, David. I want to talk through first an example of a fair value hedge and secondly of a cash flow hedge. The fair value hedge is the simpler of the two because the only modification would be of the hedging instrument. The hedged item will stay the same fixed rate instrument throughout. So in this case, the hedging instrument is a swap to pay fixed 3% and receive dollar LIBOR. It doesn't specify in this example what the term is, but let's say it's 3 months. It has previously been designated as a hedge of the cash flows for changes in dollar LIBOR, equivalent to the 3% coupon plus the principal on a 4% dollar borrowing, by 4% fixed borrowing. On the 1st of November 2020, the swap is amended to pay fixed 2.7% and receive SOFR. Now, the difference of 30 basis points between the original 3% rate and the 2.7% rate represents the basis difference attributable to the difference in the risk between LIBOR and SOFR as at that date. Okay, well, first of all, just changing the terms of the swap from LIBOR to SOFR related is unlikely to be considered a substantial modification, and therefore the swap will not be derecognized. Secondly, let's assume that SOFR is expected by the entity to be a separately identifiable component within 24 months, and therefore it's possible to designate SOFR as the hedge risk. Next, the hedge documentation is allowed to be amended to describe the modified derivative as the hedging instrument and the fair value hedge of the cash flows of a 2.7% coupon plus principal of the 4% liability. So what we've done here is to change the designated hedged item from 3% to 2.7% in line with the change in the hedging derivative, very much as was mentioned a moment ago by David. Lastly on this slide, it was necessary to fair value the hedging instrument and also to work out any change in fair value of the hedged item and record these in profit or loss. The fair value change for each of these is likely to be small, and moreover the two are likely to offset to a large degree, and so the overall net effect could be very small indeed. But there is a concern that for a bank with very many transactions, it could add up to a significant sum. Let's move on to the next slide, which talks us through the cash flow hedge example. Now, the difference on this slide is that we have got two items that will change, not only the derivative, but also the hedged item, which is based upon floating rates. It's the same swap, but this time it's been designated as a hedge of the LIBOR risk in a dollar LIBOR plus 20 basis points borrowing. So we have to first of all modify the swap, and I'm going to assume for this example that the swap and the debt are each modified on different dates. Obviously, if they were modified on the same date, then this example would be an awful lot simpler. Now, as before, the swap modification is not expected to be not regarded as substantial, and therefore the swap is not derecognized. And again, as before, we're assuming that SOFR will be separately identifiable and therefore is capable of being designated as a risk component. Now, the last element on this slide is a little more controversial, and it sets out an approach based upon the wording in a staff paper for the January IASB meeting. And this is that to reduce hedge ineffectiveness, it is possible to describe the modified derivative as a hedging instrument and a cash flow hedge of the SOFR component of the dollar LIBOR liability. I say this is slightly controversial because I don't think people in the past have ever thought of one benchmark being a component of another benchmark quite like this, but at least this does have some merit and also would be incredibly helpful. It'll be very interesting to see whether this is the approach that is followed in practice. In any event, the hypothetical derivative would have to be amended to reflect this new designation. We now turn over to the next slide. The cash flow hedge reserve also has to be remeasured. And it will be remeasured to the lower of the cumulative gain or loss in the fair value of the modified derivative and the cumulative gain or loss in the fair value of the amended hypothetical derivative. Again, each of these will be very small numbers and the net will be a very small number. And also, because of the higher of or lower of calculation here, you end up only hitting profit and loss if the derivative is more, the fair value of the derivative changes more than the fair value of the amended hypo. The important point is that although we have changed the actual designation of the hedge, it is deemed to be the same hedge relationship, and therefore there is no discontinuation of the hedge relationship. Further, the amounts which previously have been accumulated in the cash flow hedge reserve are allowed to remain there and are now based upon SOFR. In my example, the debt is then modified on the 15th of January 2021, and it's amended to pay SOFR plus 50 basis points. Again, the amendment of this liability is not considered to be a substantial modification, and so therefore the debt instrument is not derecognized. Moreover, and it's not actually on this slide, but it's worth mentioning, it is likely that this would be viewed as being an economically equivalent modification, and therefore we would change the effective interest rate to SOFR plus 50 basis points. Lastly, on this slide, the hedge documentation is changed for the second time to now be the SOFR component of the new liability, i.e. SOFR plus 50 basis points. So that just talks us through how the cash flow hedge example would work. I hope that helps us bring to life some of the points we were discussing earlier. I'll now hand over to Fiona to talk us through some of the disclosure requirements.
Thanks, Tony. Coming on to slide 19, we'll cover the final element of the Phase 2 exposure draft, the IASB's proposed disclosure requirements. In the ED, the IASB set out proposed disclosure requirements with an objective to allow users of the financial statements to understand the nature and extent of risks arising from benchmark reform that the entity is exposed to and the entity's progress in completing transition. This overall objective is broader than requiring disclosure only for those financial assets and liabilities which the entity has utilised the available relief set out in the ED for, and is intended to provide a more holistic insight into the entity's exposure to IBOR rates and its transition away from those rates to alternative benchmark rates. To meet this broader disclosure objective, the ED set out a number of more detailed requirements, including a requirement to provide quantitative disclosure of the carrying amounts of non-derivative financial assets and liabilities and the nominal amounts of derivatives referencing benchmark rates, disaggregated for each significant rate. Additionally, the ED proposed an entity should describe, for each significant benchmark rate to which it is exposed, how the entity has determined the base rate and any relevant adjustments to that rate, including any significant judgments the entity made in determining whether the conditions to application of the release discussed throughout this webcast are met. Turning to slide 20, I'll summarise the points we raised on the disclosure proposals in our ISDA comment letter and also give an update on the redeliberations relevant to this topic from the June board meeting. Overall, ISDA was supportive of the disclosure objective, but there were a few specific concerns we raised. Firstly, as it relates to the proposed disclosure of carrying and nominal amounts, we had concerns about the extent of this requirement and the availability of data within financial reporting systems to systematically meet this requirement. While we generally acknowledge the potential usefulness of such disclosures, the operational ability to meet very specific quantitative requirements, which would not necessarily align to data the firm has available to it in the ordinary course, did concern many of our members. Positively, in the June board meeting, the board voted in line with the staff's recommendation to provide some more flexibility here. While the final amendments will still require quantitative disclosure, reporting entities will be granted more discretion in using a representative basis for disclosing this information. One point noted in the staff paper as an example was use of quantitative information based on that used internally to update key management personnel on the exposures, aligning with the entity's own internal transition progress reporting. In the board meeting, a number of board members talked about the importance of the information providing context. For example, a simple disclosure of notional of derivative contracts referencing IBOR at a point in time is of little value if the entity is not also providing information on the starting point to give context to the progress already achieved and the task still at hand. A second issue raised by ISDA was on the lack of clarity on what was expected for the disclosures describing assessment of each significant base rate and related adjustment. Base rate was not a defined term anywhere else in the ED, and it was also unclear whether this was expected to be a quantitative or qualitative disclosure. This area was commented on by a number of respondents, and in the redeliberations, the staff proposed and the board agreed that this element of the disclosure requirements should be dropped altogether. Finally, on slide 21, having run through the ED and the redeliberations from the June meeting, we'll spend a few moments talking about what is left to do and next steps. As mentioned by Steve earlier in the webcast, a number of elements related to the hedge accounting proposals are to be tabled for redeliberation in the July board meeting. The intention is that this would be the final meeting for discussion of open issues and that the staff would begin the balloting process at this meeting to move on to drafting of the final amendments. We therefore hope to see a release of the final Phase 2 amendments late in Q3 or possibly early in Q4. For EU-based filers, endorsement by the EU to allow early adoption for the 2020 year end will then be the focus. As a final comment, we acknowledge how much has been achieved by the IASB in addressing these issues and giving the industry a path forward. There is certainly still a lot for reporting entities to do in terms of implementing and operationalizing these reliefs, but the framework to do so is at least now close to completion, and we'll all be eagerly waiting for the final amendments and hopefully resolution of the final remaining considerations. If reporting entities do intend to opt for early adoption and are contemplating transition of contracts from IBORs to RFRs prior to the 2020 year end, now is the time to start preparations. Waiting until release of final amendments would leave very little time to early adopt, and so we would recommend those considering such action to commence their preparations on the basis of the ED and the public record of redeliberation discussions in the June board meetings. I shall pass back to Antonio to close.
Thank you, Fiona. That's brilliant. This brings us to the end of what we wanted to cover. Let me finish by reminding that there are additional resources available on transition away from IBOR at ISDA's website, where you can find our response letter to the ISB. Thank you very much.